microphone too.
You have a microphone too?
I do. I have
But I
one.
think you sound good without the microphone.
I know. You just have that you've got a voice that
voice.
He's
just
got a face made for radio.
Ah, there we go. There we go.
That's not true. He's got a face for television. He's a beautiful man. I'm surrounded by beautiful men. I'm just
my beard. We get to
That's
the
a
beard.
good beard.
Three bearded guys.
Beard.
Yeah, 3 bearded men. Beards are very in right now.
This is Top Line.
All right, let's kick it off. Welcome, everybody. I think, is this episode 4?
4 is 4.
Episode 4 of Top Line, the podcast made for go-to-market professionals and their teams. I don't know. I don't know if that's true. I'm joined by CEO of QuotaPath, AJ Bruno, and the CEO of Sales Talent Agency, Asad. Welcome, my friends.
Hey, Sam.
How you doing?
I have one thing to say. So you introduced me usually as Anthony James Bruno, which I appreciate.
Yeah,
but I'm the third, so it's Anthony James Bruno.
Oh my
the
God.
Third. I just
Trey.
want to make sure.
We're gonna call you Trey.
Yeah, I'm the third.
And is third written as like number 3 or like 111?
Which causes issues because my birth certificate has it and my passport doesn't. So,
Where's your family originally from?
My dad is Italian side, and then my grandmother is English. She was born in the UK.
Huh. So you're like, it's the third of an Italian descent.
Yeah, sure.
Antonio.
I was probably a 6.
Antonio Bruno.
Maybe Antonio Bruno. Anthony Bruno is
from Napoli.
Yeah, my wife's Angela Bruno, and she always gets asked like, "Oh, are you related to Angelo Bruno, the mobster?" Like, no.
Maybe she is.
I don't know.
I don't know.
Maybe.
Maybe. Our first topic, as always, is well, Asad, how are you doing?
Good. I just had a smoothie and it has a bunch of things in it that I can't pronounce. So either I'm going to be dialed in or I'm running to the bathroom. I don't know. We'll see.
What's your allergy medicine, AJ?
My Claritin that I took.
Claritin. Does it have any Claritin in it?
I hope so. I've been sneezing like a crazy person. I don't know why. Maybe it's all these plants that I have in the house. But yeah.
Well, do you live alone?
No, I have a partner.
Who is your partner?
My partner is this very nice person. Her name is Sherry, and so she keeps me sane. And I've been with her for 6 years.
Oh, well, that's wonderful. What does Sherry do?
Sherry finds things that are a couple of 100 years old that you can't find easily. She buys them somehow, and then she auctions them off. It's like I live with the female version of Indiana Jones. It's fascinating.
That's the most flattering description of that profession. It's very
You didn't take it that way. I was like, you're like the female Indiana Jones, and there was like a very subdued face in return. I was like, okay. I thought that was a massive compliment.
I think so. Harrison Ford's a very attractive person.
Yeah.
All right, let's talk about the state of things. Asad, what's your take on the state of things? There's you particularly over the last week have spent a lot of time with analysts analyzing the economy and the market. And I know AJ's done the same. Why don't we start with you as we do and get an overview of what's your take on the startup economy, how things are going, the financing economy. What's your view?
Yeah, so as you said, spend some time speaking to the analysts at PitchBook. PitchBook has been putting out some great data. So I wanted to be able to have a conversation and dig into some of this data, specifically for our listeners, because we speak about the market a fair bit. They like hearing about it. So it's like, can we bring something interesting that's beyond what they can find out there? And so a couple of episodes ago, when we were talking about tech, we broke tech into these 3 buckets: early stage companies, growth stage companies, and publicly traded. And one of the things we were saying is that early stage companies should be quite secure from a fundraising perspective because they don't have as much of a valuation problem to deal with. And the venture numbers over there back that up. Public market companies respond to things like interest rates very quickly. So they should be dynamic in terms of how they react to the market. But we were concerned about this growth stage. And so that's what I dug into. And so what they said to me was interesting. They're like, look at company building as a supply chain. Every sector has a supply chain. You go from idea to scale to public. You've got investors that are there giving you money to go through this journey. And that supply chain is really prominent in tech because of the number of companies that are on it, the speed at which they grow, and the valuations that they can get because of their business models. And so one of the things they looked at is just how many of these companies are out there. And it turns out in 2018, there were 25,000 companies between seed and Series E. That number is 50,000 today. And so it has doubled. And the biggest challenge for this growth stage is that IPOs are not happening. So in 2021, we had 2,000 IPOs. It was a record-setting year. And then the public markets completely shut down. There were less than 250 the year after. And so right now, you have a lot of companies that are growth stage companies that are stuck. They can't go public, but they need a cash injection because when they raise last, they've gotten by till now, they can't survive that much longer. So they try to figure out how much money do they need and how much are they getting. And this was the most fascinating thing they shared. For every dollar that a growth stage company is raising, they actually need $3.2. And so public markets aren't opening in the near term. And even when they do, they don't prioritize fundamentals that these companies don't provide: profit, low CAC, great LTV, great net revenue retention. So public markets are not happening. Privately, they aren't able to raise the type of money that they need. So if they're essentially raising 30% of what they need and SVB isn't there to top that up with another 25 to 50%, what happens? You have to cut costs. Your biggest costs are people. And this is what I think will lead to layoffs of thousands of companies laying off thousands of people because they just don't have the capital to sustain the type of workforce that they have currently. So that's one of the big challenges over there. And the other part that comes out of that is that you've got a lot of investors that have a lot of money stuck. And that has implications for their relationships with their LPs and how they deploy money moving forward. So it's probably the largest risk factor in tech right now is this stage and how stuck they are.
So Asad, that's not good news.
Yeah, it's not exciting.
What is relative to the percent of people that have already been laid off? Like how much more is there to go to your point? And that $1 for every 3.2, that's a fascinating statistic. So you've earned your keep as a co-host.
There we go. I get to stay. I think there is a world in which you could debate that these companies have to go down by 50% in terms of workforces. There's a lot of companies at this stage. They all have lots of employees. If every company has to go down by 50%, you're looking at layoffs that could be at par or more than what we saw in Q1. Remember, Q1 layoffs were more than all of 2022 put together. Q1
I didn't know that. Don't say remember. Yeah. You didn't share that with us. Yeah, how many layoffs were there in Q1?
Like 157,000 or something like that, 157, 165. And I think all of last year was something like that. So Q1 was really bad from a layoffs perspective. And you could see when this comes to head, probably something similar, if not worse. Because this SVB thing is important. I don't know if they take SVB into that calculation over here.
Well, there's a lagging factor. I mean, you already talked about that. I think the other side of this is that we talked about this in terms of just like anecdotally feeling like this was going to be the case. And now we're starting to see those stats come up, Asad, where the way it was viewed was like this, the public market was the train. Like you saw the train, the engine, just like motoring along and coming to a screeching halt. And here we are hanging out in the caboose. Yeah. We're like, well, we got some time. We got some time. We got some time. Don't worry.
We have no more time.
No more time. And like the data that I saw, Carta just put this out that was just pretty fascinating. And it mirrors a lot of things that Asad said. But a big part of this was the one stat that caught me. It said, in a time of market upheaval, many startups are coming to an impasse, and a growing number are choosing to cross it with a bridge. Lots of bridges. There are so many bridges. People will use their Series B as a bridge in a lot of ways. Now, at least
AJ, explain for the listeners. I'm going to explain for the listeners like the mechanics of a bridge.
Yeah. A bridge round is in a traditional market, a bridge round was used at like we're growing at a pretty nice rate. We've overinvested sometimes in growth, in headcount, and our runway has shortened because of that. Let's say we overinvested and we shortened our runway from 12 months to 6 months. And we go to our current institutional investors and say, look, we're growing at a great rate. We'll give you a pretty good deal on investing and putting more capital to work. We'll let you invest at the same terms as the previous round. That's like a traditional bridge round. The bridge round is like just using the last 2 years, we're always in an up valuation. So it's like, hey, I could go out and raise this Series B right now, or you could put a little bit more money in at a 25% premium on the round. And that's what's just taken, because it's just capital was right there to deploy. So like a lot of the early stage funds were way over their skis investing in companies that were up market from like where they traditionally did, because they put, they might have a holdback. So they'll put $2 million to work up front, and they hold another $4 million of capital for future rounds in that organization. And so a lot of that was now being used to lead these bridge rounds so they're over allocating capital to some of their internal companies. So they weren't able to diversify into like, they might have a fund that says, okay, the thesis is we're going to go out and invest in 10 companies. But when you over allocate into your upfront companies, then you can't reinvest in those or reinvest in other companies. And then cross-pollinating on funds was even worse. And that does happen where you basically, on paper, create a valuation where you're like, well, we invested in this company when they were 10 million, and now the valuation is 50 million. They don't say anything about that. They led the $50 million round with their other funds. And so those bridge rounds were happening pretty frequently. And so what you're seeing then is in this time with the bridge where we're not seeing all of these bridge rounds. I think it said at least 40% of all new fundings at both Series A and Series B were bridge rounds in Q1.
40%. That is 40%. A huge number.
Huge number, which in the case of a Series B is more than double the rate of a year ago. So huge number, because it's like all of these funds stopped taking meetings with new founders, and they said, okay, let me fix my current companies and make sure they're in a good spot. And by doing so, they're like, well, just get to September, but September's not good enough. You need to get to Q1 of 2024. Yeah. So let's figure out how to patch you up, cut everything you possibly can, on spend. I mean, so I didn't think it was going to hit software as hard as it did, but it hit software. It hit layoffs and headcount happen first, software, budgeting, spend. And then to Asad's point is that there's a second round coming where it's like, shit, we didn't cut deep enough.
AJ, one of the things that I heard over the last couple of days was that it's hard to know what type of repricing is happening, right? That's a really lagging data point, because unless companies really have to announce it, like Stripe had to announce it to the markets, most companies don't hold that information back. But one of the things that is easier to find is what type of deals are being made on these bridge rounds. And it seems like there has been a massive increase in using structure during
participation,
right? So even things like liquidity, preferred rates, etc.
Participating, yeah.
Can you speak to like the implications of that? It seems like that can only work out for everyone if the company is able to really make it. But in all other scenarios, what are some of the downsides of overusing structure to take this extra money?
We had in our Series C at Trendkite, my first company, we had participation rights on it. It was basically IRR. So our Series C that came in on the lead said like, look, we're guaranteed this return. And I think it was 67%. It was late stage. So late stage, you might have participating in early stage that's like 2x, 3x. Basically, they're guaranteed the return. And what that means is when you look at a preferred stack, is if you liquidate the company, let's say you invested 20 million and you have 2x participating, and the company sells for 50 million. Well, that preferred is getting $40 million off the top, and then the common is getting the rest of it.
So I don't think have very little incentive left.
Usually with this, because it's something that in early stage isn't thought about. You're like, well, I'm not really worried about that because we're going to go to the moon. We're going to become a unicorn. Or on late stage, then the CEO, and usually at that point it's a professional CEO, is a part of this participation. So they get topped off on shares. And so like they're the ones writing the deal and taking the deal. The common doesn't even know this in most cases.
And common is employees and executives and all these.
Yeah.
Founders,
So if you're out there and you're an executive
typically.
and you're like underwater, so that repricing piece of it on the 409A, which was super fascinating. Now there's a company out there that was doing pretty well, and their common was $26. It just got repriced at $5. So think of all the employees that exercise their options. Now, not only are they paid for those options, they got AMT taxed on it, right? Everyone gets AMT on that. And now they're got just destroyed. And basically their options are worthless at this point in the game. And now they have the horizon of like, well, we need to get back to where we were at base level 2 years ago, which is 5x from where we are now. What the hell are they going to do?
Yeah, like how do you hold on to anyone good at that point? Like there's really no incentive for them to stay.
No.
Well, I guess that's what people talk about, all these folks starting AI companies, but this is a real problem. I mean, all of these 40% were bridge rounds. And the purpose of the bridge round is to kick the can down the road and to say, we don't want to know what the company's worth because that information would have us mark to market our portfolio. We'd have to share that with our LPs. We'd have to say that the portfolio is down 30 or 40%. So we really are, if that's 40% of what happened. And then Asad, I think either you or AJ shared the data that was there 15 total series later than Series D, or was it Series C or later? 15 total deals in Q1.
500 million. Yeah, 15. That was in the Carta data. 15 total deals, 500 million in capital invested.
So that's like, it's not even like have and have not. There's a few companies that are doing well. Everybody else is struggling. And it's not about, you're not really graded on a curve. It's not about that. It's about what is the enterprise value based on your growth rate, based on your burn, based on unit economics. What happens? I mean, this is, I was saying, even as recently as last week, I was saying maybe we'll come out of it in the second half, but this data tells me that this is going to persist through Q1 of 2024. I mean, certainly I'll tell you that Pavilion is experiencing it as much as, I would love to be I loved it when, when people are like, oh, you should really try to build a must-have, not a nice-to-have. It's like, well, no shit, dude. Everybody's trying to build a must-have.
Sam, no, everyone's going through it. Like my good friend is a sales leader at a GPU compute company, and they grew like
they've got to be crushing it.
He is miserable right now.
Wow, why?
They're crushing it. They can't find GPUs. Like there's supply demand issues.
That's what we call a nice problem to have.
You would think that, but he can't control it. He's on the hook from a sales leader standpoint on numbers that he literally can't control. So like he had a phenomenal 21, 22, 22 because of crypto, and he is like beyond frustrated right now.
Wow.
Like, so everyone has their like chink in the armor. And I think that's the thing we all sit here. If you're on the other side,
let's get constructive here. Let's get constructive.
Fine. Yeah, I know.
Let's get optimistic. I did just.
Sam's saying, let's get optimistic. That's the part we hit in this.
I'm talking to myself here. What are the positive strategies? Besides, by the time people are listening to this, it'll be over. Pavilion's hosting an RKO, a re-kickoff tomorrow, but this will come out on Monday. So it was last week with Jason Lemkin, Pablo Dominguez, Jocko Vanderkoy. We're going to be talking about what you can do, but what can we do? Let's get positive. What do we need to do?
The first thing I think that I've been thinking about is there's this huge, like, I don't know what the right word is, maybe restructuring, rebalancing that's happening in the world of tech. Like what's been prioritized in terms of business fundamentals has shifted. And this new type of list of fundamentals that have been prioritized will be the status quo for the near term. So I think there's an interesting shift there. It's making company building and managing a little bit more sustainable, which will create stability over time. I think that's a massive positive. You're seeing that even with companies, how they're hiring is also a change in mindset, because you've got this data around the roles that have been laid off the most. At the same time, companies are hiring, but they're not hiring those roles back. They're prioritizing some other types of positions. So you can see that there's a bit of a shift in mindset. And I think for professionals, there are a group of companies that are going to face a lot of pain, but there are lots of opportunities in this market as well. Like if you're a go-to-market professional, you should be really excited about the fact that AI is here. You've got early stage investment that stayed quite stable. So there are opportunities over there. And especially if you're tech selling into other sectors, they don't have as many problems. Like that's an easier part of the market to assume that you'll be able to create momentum with versus tech selling into tech. So I think there are opportunities here for people to shift their careers a little bit and position themselves for a career that is stable over the long term and has tons of interesting upside. So I think that's an interesting way to look at it, trying to be positive.
Well, the other positive I would say here is I think it's a great opportunity. I mean, I am very optimistic about what we're doing and how we're doing it. And, I think the data is a lagging indicator, Sam. So like the negativeness of it is something that we were going through in Q1. So maybe on the good news is you already went through it. You're good. And the other side of it is though, it gives you an opportunity, a lens. Like when COVID hit, the whole world just stopped for a second. And we got this weird, rare moment to do something about it. Yeah. Pavilion did it in a very, very fundamental way. Like you all took in person, like how are you feeling at that moment in time? And look what you did and how you were able to transform. Transformation 2021. I remember giving the like, oh, transform. Well, that's what we did. And we don't have to go through that full transformation, but we do have to think about what is the killer value prop? What's the vision of the organization? What are we actually trying to go out and do? And for QuotaPath, one of the things I about a month ago was thinking about from a strategy standpoint, I was like, and I need to call a management offsite right now. Like we have to really buckle down and really fundamentally understand our ideal customer profile, understand some of our strategic alignment things, some of the ROI things that we're working on that we're really excited about. We have a company kickoff in June. And I'm going to be up on stage talking to the team about these things. And so like, if you're going to stick with your organization, be a part of the solution, not part of the problem, and just like really ask the questions of like, what is it that we're really going to do that we're coming out of this in? Because this will pass. It's going to pass.
It will pass, but it's going to be a while.
Maybe.
But I think there is this, like the way that AJ spoke about it, it's really interesting. Your business benefited from the last downturn that we had, right? Like that's where.
But I think, let's be clear. I mean, I'm not trying to be such a friggin' Debbie Downer, and I'm sorry, but it was a different downturn because the Fed pumped money into the economy. This is a downturn with no support system. This is a downturn, as you said, Asad, with no Silicon Valley Bank, with the Fed raised rates 25 basis points today. That was literally, the alert I just got on my phone. So that downturn. Everybody was like, here, let me extend unemployment. Let's do PPP. Let's make sure that everybody has plenty of money to stay home. This is a downturn where, because of inflation, the U.S. government and the central banks of the world are basically forced to say, hey, everybody, you're kind of on your own for a little while until unemployment, because that's what they're trying to do. They're trying to stop inflation, which means they want layoffs. They want that, they want us to be scared right now. Yeah. They want valuations down. So with that caveat,
if you look at the three things that played out in the last downturn, you had quantitative easing, low interest rates. That's not happening. And that was a big part of what helped everyone. But the other it was a period of time where there was a lot of change. There was a lot of anxiety in the system. People wanted to turn to community to try and like empower themselves or equip themselves to be able to navigate through that. And it also, for that initial bit of the lockdown, gave everyone an opportunity when the economy had shut down to step back and look at the stress test on their business, as AJ said, and figure out the adjustments they needed to make to move forward. And you don't get those stress tests often, but those stress tests are good for us as businesses and as individuals. individuals, 2 of the 3 are still available, right? It might not be the same type of benefit because quantitative easing and interest rates were so massive as part of that, but there's still an opportunity to be proactive and also realize the 3 businesses over here are not Series D stage businesses that are kind of in no man's land. I think the rest of the market, it's an interesting period and you can still power through it and it will end at some point.
See, Sam, do you feel better already?
There we go. That was me being Tony Robbins. You know what won't work?
Well,
Have you guys heard of bare minimum Mondays?
I have not heard about it. I think I did. Tell us about it.
What is this?
So there's this new thing on TikTok. I'm not on TikTok, but I read about this, where it's this new trend where they are basically saying bare minimum Mondays are the way that you should go into your Monday, where you should do the bare amount of work that you have to do, because if you do too much, it's too stressful. You know, you don't overextend yourself, and so do the absolute bare minimum. And it's interesting. Like engagement rates in companies have been dropping for a while. It's at the lowest it's been in a long time. At 32% of employees in North America say that they are engaged at work, and these type of things just keep picking up. And I feel like this is just like the worst piece of advice anyone could get is have a bare minimum Monday in a downturn. Like that's one way not to have job security. It's one way not to have upward mobility, and it's probably worse for your finance, for your happiness, because if you lose your job, you can't make money, you can't grow in your career, you're not going to be a very happy person there. So this won't work.
I don't know. I saw a tweet that said Gen Z is amazing. I asked a paid intern to bring me 50 blank pieces of copier paper. And when she brought them in, they were warm. Turns out, rather than count them, she set the copier to 50 and printed out 50 blank sheets. Genius. Is that bare minimum or is that genius?
That's genius. I think. Well, all right. So why did you bring that up? I said, let me provide a perspective on it. I mean, I think y'all are younger than me, so I don't think I am the oldest person on this podcast.
I'm Gen Z for sure.
Is there an issue? Is there something that we should be? I just feel like, is there a resetting that needs to happen? And how does that reset happen in terms of work expectations? I also think it's difficult because, again, it's hard you don't want to be a micromanager. You don't want tracking software that says how many keystrokes did everybody type if we're all going to be often work from home or remote. I tend to think that the best thing to do is try to create objective outputs and hold people accountable to the outputs as opposed to the inputs, and not really worry about, what time they're clocking in on Monday or Tuesday or any other day, but just hoping that the work will get done and that we'll be responsive to our customers and help them get where they want to go. But what do you think bare minimum Monday represents, Asad?
There's a friend of ours who I was talking to last week, and he was sharing that he gives unlimited vacation to everyone. And he looked at the data, and in Q1, there were multiple people that took a month off. They took 1/3 of the fucking quarter off, right? And so I think this is where there's obviously a spectrum. There are people that are completely dialed in and they understand it's wartime and they're doing all the right things. And as an organization, as a leader, you need to optimize to have a lot more of those than people that want to do things like barely work on a Monday. Like it's Monday, it's you starting your week and you want to do the bare minimum. Like I think that is a challenge. And there probably has to be a change, but there's always this spectrum. It just seems like this part of the spectrum where people are highly disengaged and are now vocally trying to like promote being disengaged as a good thing. This group has increased in size, right? Because engagement rates have gone down, and that can be a massive challenge. I don't think it doesn't make me feel scared, because I feel like if you're good at hiring, you'll hire more people that are going to be dialed in, and you'll make mistakes and you'll correct those mistakes quickly. So it doesn't give me anxiety as a leader. But when you think about it from a macro perspective, it's very challenging for the economy to have all the challenges it has right now, and then almost 50% of the employees out there are disengaged at work. And it's a combination of, I think, faults by the employer and then also just people themselves. Both have to change. Employers are not blameless probably in this, right?
What do you think, AJ?
Oh, we use key logging software, so we're fine. I'm just kidding.
I
One
like
of
that you
my-
say,
What
so
about
we're,
applications
we're
not
fine.
going-
You know, the minute you hit less than 2,000 strokes by 4 p.m., you get a little shock in your
You're
rear
done.
end.
Yeah, a little shocked in your seats.
Part of your
I mean,
home
it's-
setup. We send you a
I'd
tech
love to say-
stipend and you have to insert the electrical.
I'd love to say like I don't think about this, but I think about it a lot. And I even think we have a really engaged company right now. And it just, part of it is I don't want to feel like an old timer on this. It's a boomer thing to say of like, man, I just remember the 8 to 5, 70 cold calls a day, days, like couldn't leave a minute before. And it just feels like we have a sales team that's doing well, but I'm like, you know, whether it's outbound or whatever the case may be, I'm like, what are they doing? You know, what are they doing during the day? And it's something I probably think about, and that's not super healthy, given that we want to put so much trust. We hire this team. Our teams have gone through layoffs and rifts, so we've left like the really great people back. So like the more we probably lean in, the more someone might lean out. So it's just this living on the edge mentality that we're all feeling right now. But I just think as an employer is like, I want to be harder on my team and I want to do it in the right way. But
That's
like
interesting. Harder.
Yeah.
That's how you frame it to yourself. You want to be harder on your team.
I think there's the AJ that's matured, and then there's the AJ like 7 years ago as the VP of sales that was just like, you came in a minute past 8:30, I sent you home.
Are you
And
serious?
Yeah, no, that's very serious. I was very,
Wow.
very serious. Like, and I always pitched it, and this is the story I told myself is like, well, the team's like in at 8 already, so they're getting ready for their days. And it was very rare that anyone was late. But after I like left, they still kept that rule, not left, but moved out of the sales leadership role. And I was walking down Brazos Street one day in Austin, and I saw like 3 sales reps like sprinting up Brazos. And I was like, oh, I'm making sure I'm in seat on 8:30. And it just felt like I like that. But then I think back to that, I'm like, there's a different way. And I think employees have realized that there's just a different way. One of the things that in our 360 ENPS score that came back, someone said, I love the laid back culture of QuotaPath
Oh no.
and work-life balance. And I was like, ooh, like, and it was only one of those, but I was like, oh man, is that really, as a startup, as like a company that like we're all trying to just make sure we survive through this year, regardless of how much capital every organization has? Like, is that the right precedent to set? And I just like had to take a pause, talk to my CEO coach about it, and just like, you know what? It's okay. I got to work through my management team. I'm not going to single anyone out on Slack. That's not the right thing to do. So I'm okay with
I
it.
have a question for the two of you, because to the point of like me opening the show with a little bit of a, you know, like I'm not even low energy. I've been like getting good sleep. I haven't been drinking. I've been drinking a fuckload of water. I've been running. Ran 6 miles this morning. So I feel like I'm trying to get into what I had lunch with Brandon Barton on Sunday and his amazing family up in Connecticut. And he said he's in turbo mode right now, running bike. And I'm like, I'm in turbo mode. You know, like I am intense right now this week for the past 3 days, but I'm still up and down from a mood perspective.
Same.
And
Yeah.
Asad, are you even during the day?
It's something that I want to be all the time. And I think about it a lot. I try to solve for it, but it's impossible. I think it's a volatile market. It's a volatile job. Like it's hard to be like that all the time. You're just trying to be in that mind frame as much as possible. There's some things that work. And the annoying part is there are things that you start doing that work for a bit and then they stop working. And so you're always just wrestling with this damn thing. So like an example is exercising, right? Like if you're not exercising, you start exercising, you're like, whoa, great. I found this thing. I feel great. And then you're 4 weeks into exercising. It doesn't have the same effect on your mindset and your stress levels. So I think it's this ongoing, never ending battle. And it's the hardest in a market like this. And I have no like great ideas on how not to be like this. Maybe AJ does.
Sam, you're up and down then as well during the day.
I am so up and down. Yeah. I mean, what is authenticity, right? This is the point of the podcast. I am so up and down that I have been considering medication recently because I'm like, I feel like it's not healthy and I feel like it's going to have an impact on the company. and we're thinking about having kids and stuff like that. And I'm like, I don't want to be so up and down to my children. I don't want them to feel like if I log into ChargeBee and don't like the ARR number that I see, that like all of a sudden I become a demon. So I don't know, but I just feel it's caught up with me a little bit in the sense that I'm trying to stay optimistic, trying to focus on the long term, trying to focus on the big vision. And at the same time, like we're trying to the NPS for Pavilion and for our customers 2 years ago when we were smaller and it was more intimate and it was simpler was much higher than it is today. And it's not that anything's uniformly, it would almost be easier if it was like uniformly terrible or uniformly bad or uniformly negative. I don't mean to use, words of hyperbole, but there's so many positive data points and there's so many not so positive data points. And like trying to find the signal and trying to figure out like, okay. And then the reality is like, I just, I don't run a recruiting agency. Asad runs a recruiting agency. I cannot imagine what it's like to run a recruiting agency right now. and you have these benchmarks from previous years where probably, I'm sure, what was your first year as CEO? Was it 2021?
2020 Q4, I became CEO.
I mean, they must have felt like they just stepped in shit putting you as CEO in that, like I'm sure you had the strongest year ever. Yeah. I'm sure 2021 was like.
We grew 65% in the first year.
Yeah, exactly. And you're like, and so you have this, we're all these, we talk about this. We talked about this on the first episode, but you have this idea about who you are and how it maps to your company performance and how it maps to your performance. And you have to remember that we're all part of the economy. And, every one of us is not doing quite as well as we wanted to be doing this year. And I'm sure, we put up big plans and projections in Q4 and we're like, we got to triple. And it's just because we felt obligated. We had to say those things. That's what, our investors expected. But the reality is we're in those numbers that we talked about at the top of the show, those are difficult numbers. And so, I want to be a good boss. I want to be a good partner, and I am optimistic over the long term, but in the short term, I got to make it to the long term. Not that it's existential, but it's just like I'm constantly, just trying to make sure that I'm not too up and down, and I feel up and down inside, and it's a battle.
Well, I mean, Sam, I am, first off, kudos to you, and just like when talking through that. I mean, we hear the CEOs are lonely path, and no one feels bad for CEOs. No one gives a shit how hard we work. No one cares. Like, it's just like, that's the thing we have to do. But we always just feel like we have to be on, like for our company, for our families, for ourselves. And it's really, really challenging. My daughter came home last week and she handed me a piece of paper, and it was a poetry. And she had to write a noun, adjective, verb, and then like a 4-word phrase. And her poem was, Dad, hardworking, helping, loving, smiling, loves working and working. That was her. Yeah. And so when you think about that, it's just, we're in this really, really challenging, as a founder for the last 12 years, I've just like always been on. I've always been on. This just feels different. And like, I took one of my daughters out for date night and it was great. I turned my phone off during dinner. It was awesome. But it's just like, it's those very quick moments that we get. We don't have that, like, just kind of even, there's just doesn't feel even killed. And for the volatility piece of it, when we cite those numbers, we're just humans. They hit us just as hard as they hit everyone else.
They've hit me so fucking hard.
Yeah.
But back to our mutual friend, Brandon, and I'm sure we'll get him on the show.
Turbo mode.
Well, no, he's like, because, first of all, we're we talked about some companies that we won't name before we start recording. I mean, Pavilion is objectively a medium-sized company, like we do more on, we do, the company that you mentioned, Asad, where you have some friends that's doing about $1.5 million in revenue, really? Like that's what we do in a couple of weeks, so I should be so grateful. But I have these ambitions. But Brandon says, you can't hit the game-winning shot if you're winning. You cannot hit the game-winning, and I'm that's sort of this week. That's the mantra of like, and it's not that we're losing. It's just that like this is an opportunity. This is a challenge, right? If we're going to write a narrative, if we're going to write a story, if it's going to be a hero's journey, the hero's journey has to face adversity. This is the adversity. We're in it. We've got to fight our way through it, and it's going to be this amazing story of Michael Jordan hitting the game-winning shot, etc. That's sort of that's.
I think there's also like a important call out, which is like, and I think it's there are so many businesses that overextended themselves, and those are the ones that are really tough spots to be in. But if you can even get yourself to not burn money and just stabilize and get through this period, this ends, right? Like market cycles, like you can look at history and see that the markets always go up and they always go down. And as soon as they hit the bottom, then they really have a good period after that. So it's like about powering through this period. But even with that information, it doesn't make it easy, because during the good times, we're working just as hard, but there's so many wins, right? Like these little dopamine hits all day. And that gets you through the day. When I end my day at 8 or 9 p.m., I'm feeling fucking fantastic because we had all these wins. It doesn't feel the same way on a Thursday in Q1 2023, where you've just gotten tons of bad news. The other thing that's exhausting sometimes is that whenever you go into a meeting, you're trying to be completely at your best in that meeting, right? And so that takes a lot of effort in a market like this, where you're not naturally in that zone. And when you have to push yourself to be like that, I think after that, you feel that much more exhausted, which makes the marathon of getting through this so much harder. So it's just a fascinating period of time. But getting through it, like when you look back, these are the periods of time where you learn the most, you grow the most, you look back at fondly, they become part of your hero's journey. They're annoying in the moment, but great when you look back.
Well, certainly I'll say that it's a lot better to go through the great thing, about it's just been it's been crazy. That my life has been crazy the past, since I got fired from Behaveox in December of 2018. So that was 4.5 years ago, where I had no expectations at all. And so that was a beautiful moment. Doug Marsh from Built to Spill, you all probably don't listen to good music, so you might not know who that is, but they're an indie rock band from the Pacific Northwest. And he's, their breakout record was called There's Nothing Wrong with Love. It's a beautiful record. And he said after that record, I knew that people were going to be listening to the songs, and there's an added level of pressure. And so, it was great when nobody expected anything from Pavilion, from Revenue Collective. And then, we raised this money, and then my expectations of myself became so heightened and so intense. And it's lonely to be the CEO and the founder. And, you feel, but my point is, but the one thing that I rely on is friendships with guys like you, with people like the both of you. And the community that we've built isn't just for other people, it's for me too. And now I've got all kinds of different people that I've helped, that we've helped find jobs, that we've helped make money, that we've helped build consulting businesses or advisory businesses. So I know there's, again, we're recording this tomorrow when we record it. Last week, when you listen, dear listener, we've got Insight Partners is rooting for Pavilion. We've got Winning by Design is rooting for Pavilion. We've got the Arbinger Institute is rooting for Pavilion. We've got Jason Lemkin from SaaStr is rooting for Pavilion. There's a lot of people that believe in what we're doing and that want us to succeed. So I know that there's enterprise value. I know there's value, it's a wild ride, to be in it and to not, it's the way life is. If it was guaranteed, if it was just smooth sailing the whole time, we wouldn't have earned it.
Well, Sam, I think it's actually really, you bring up a really interesting point here, is that like in the moments of time when you think about that and all the support and all the people that are like helping build the community, those are the highs. But then you think about the one NPS score that comes in, or you look at some like credit card statement or something that's comes through that has one piece of negative, they can just bring you crashing down. And there's that great Harvard Business Review article that talks, I forget how many it is. It's like something ridiculous, like 27 signs of positive feedback, and you
Equal
can then
one.
give like one critical negative piece of feedback. And it's so true. And it's like we as CEOs think we're like, and like we're just, oh, we can handle any of those things without it. But no, we're just humans. We're just humans. So, Sam, you're doing a great job, my friend.
You're doing a great job, AJ. And Asad, you're doing a great job. I would
He's
hire
doing
both
okay.
of you.
Asad's okay. Don't worry.
I would hire
Asad's
Asad in a
I
heartbeat.
have a question for both of you. So you guys were professionals in previous downturns. Like forget the 2020 like thing that happened because it was very unique. But like in 08 and 2000,
Yeah.
you guys dealt with that as professionals in jobs, and now you guys are going through this as CEOs. What's the difference in like how it feels when you are the VP of sales or CRO versus when you're the founder CEO?
When you're a sales rep. I was a sales rep in 2008. I didn't know any better. Like I always make this joke, like we kind of made games and made kind of fun of this situation, which we literally didn't know any better as 21, 22-year-olds. And I remember I became the director of the office in 2009, I want to say. And one of my reps was calling someone and I heard it wasn't going well. And she called them and hung up. And she's like, well, yeah, I called this company Lehman Brothers and one person answered and they said she's the only one in this office and they're not a company anymore. I'm like, you called Lehman Brothers?
Yeah.
So we could like joke about those things and it felt like silly because we didn't know we just didn't know any better in the situation. And yeah, we all made it through and had 10 years of good times.
It's such an interesting point because I look at so many organizations that don't do a good job at explaining the environment that they're in to everybody that's in the organization, forgetting that such a big portion of the people that are working there are 21, 22, 23. They don't know all of this stuff about interest rates and macro. They're not reading the news the same way. And so if you want them to be dialed in and on the right page, you kind of have to like teach them what's actually happening. And a lot of companies don't spend a lot of time on that.
My observation, the thing that I always observed from 2008, I entered the workforce in 99. So, and it was very similar to 2021, where I worked at a place called Stern Stewart. And I just remember like people that you wouldn't expect to be involved in the stock market, talking about the stock market. That's kind of how you know it's a bubble. In 2008, everybody, I went back for a fantasy football draft in Northern Virginia, and every person I met was involved in real estate. And everybody was, you got to buy low income housing. And, there was like the scheme to buy a bunch of properties outside of Baltimore. And it felt very much like crypto. It felt like a bubble. So you can recognize the mania at the same time that, the reality of asset bubbles is that, sometimes lightning strikes in the right place. And if you time it, Mark Cuban is wealthy because of timing a trade in the first .com boom. My experience is that we're all interconnected, all living things. And what I mean by that is we are part of the economy, and that all the bits of your life are all tied together in ways that you don't really expect. When the stock market's up and when asset values are up and when people are hiring and when people are making more money, I have no idea if this is true, but I would expect that people get along better in their relationships. I bet that home life is a little easier. I bet that like all of these pieces, and I say that because I was making all this money at GLG, and then GLG went from 280 million in revenue to 230 million in a year, which is significant, right? Significant. Now they're back up to 600 thanks to low interest rates. So hopefully, Jerome takes it up 25 basis points. Like maybe next quarter we can go back to zero again for a little while. That was also when I got divorced. I'm remarried, of course, but it occurred to me years later, like those things are not. I view them as completely distinct, but they're not really that distinct. Yeah. Good vibes coalesce and people participate in the good vibes across multiple dimensions of their existence. And similarly, negative vibes, we're in a difficult economy. Things are difficult. That means that you bring added stress back to the back, to other places. So that's my main lesson from 2008 and from 2000 is like, it's all interconnected. This too shall pass. And, we're on the hero's journey. We've got to be strong. We got to be resolute. We've got to be optimistic, even when it's difficult.
Yeah. That's a great ending statement here. I love the resolution and just stand up to it. We're gonna be okay. Where did you start this call, Sam? And now where are you?
All right. Well, this was, we'll probably let's get some feedback. If you haven't given us 5 stars on the iTunes store or any other place where you rate your podcasts, please do so. If you've got guests we want to bring on, I bet we can bring on some of those analysts that you've been talking to. I bet we can get
down. We'll bring them in. We'll do segments so they can come in for 20, 30 minutes, talk about a bunch of shit. Then we can break it down.
That sounds great. And if you want to reach us, you can email any of us or find us on LinkedIn. AJ Bruno, the CEO of QuotaPath, Asad Zaman, the CEO of Sales Talent Agency, Sam Jacobs, the CEO of Pavilion. I don't have anything else to announce. You're going to be listening to this, I guess, June 8th CRO Summit in London. Are both of you coming to that? I hope.
We should do a top line episode there.
Oh my God, that would be amazing.
That'd be fantastic.
Yes, we'll do it. I want you to come to London, AJ.
I have my summer kickoff.
Oh, all right. Well, then we can't do it.
I will be in Nashville. I'll be in Nashville in the fall.
Good. All right, everybody. Thanks for listening to Top Line. We'll talk to you next time.
Bye, everyone.
Bye.
Thank you for listening to this episode of Top Line. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.